There is no third option. Preservation also means selecting battles carefully. Not every market condition deserves exposure. Not every movement is an opportunity. Standing aside is a position, and often the most profitable one. The trader who waits preserves not only capital, but clarity. Clarity allows decisive action when conditions finally align. Time is the hidden ally of the disciplined trader. Capital protected today becomes opportunity tomorrow. Capital lost today removes choice. The trader who survives bad periods is present for good ones. The trader who overextends during uncertainty is absent when clarity returns. This principle never changes because human nature never changes. Greed pushes traders to risk too much. Fear pushes them to abandon structure. Preservation resists both. It keeps size appropriate, expectations realistic, and emotions manageable. It allows the trader to think instead of react. Every great run in trading history was built on survival first. Those who endured respected risk long before they enjoyed reward. Capital preservation is not conservative, it is strategic. It is the foundation that allows every other rule to function. Without it, no system, no insight, and no experience can save a trader from eventual removal. The market is patient. It waits for weakness. Preservation denies it that opportunity. Every trade must be defined before it is entered, or it has no structure. Structure is what separates speculation from gambling. The moment a trader enters a position without knowing exactly where it is proven wrong, he has surrendered control to emotion. At that point, the market is no longer being traded, it is being endured. Hope replaces logic, and hope is never a strategy. Risk is not something to be managed after entry. It must be accepted before commitment. A trader who waits to see how a trade feels once money is involved is already late. The professional defines the invalidation point first, then decides whether the potential reward justifies the exposure. If it does not, the trade is dismissed without hesitation. There is no negotiation with unfavorable mathematics. When price reaches the point that invalidates the original idea, the trade is no longer a trade. It becomes a mistake that is still open. Staying involved beyond that level is not patience. It is refusal. The market does not reward refusal. It exploits it. Many traders confuse endurance with discipline, holding losing positions in the belief that time will rescue them. Time does not heal bad trades, it magnifies them. The discipline to exit when wrong is the most difficult behavior to master because it attacks ego directly. Admitting error feels like weakness, but remaining wrong is far more costly. The professional understands that being wrong is inevitable. Staying wrong is optional. Losses taken quickly preserve capital and clarity. Losses delayed corrode both. A clearly defined risk also stabilizes emotion. When the maximum loss is known and accepted, fear loses its power. The trader is no longer surprised by adverse movement. He is prepared for it. This preparedness allows rational decision-making even under pressure. Without it, every tick becomes personal, and emotion escalates rapidly. Many traders widen stops to avoid being wrong. This is self-deception. A stop exists to protect the integrity of the idea, not the comfort. T of the trader. If the stop must be moved to stay in the trade, the idea was flawed from the start. Adjusting risk to accommodate hope only ensures larger damage when reality asserts itself. Consistency cannot exist without predefined risk. Without it, outcomes are random and emotional. With it, results become measurable and improvable. The trader learns from repetition, not from chaos. Each trade becomes a data point instead of a trauma. The market respects decisiveness. It punishes hesitation. When the line is crossed, action must follow. No debate, no justification, no stories. The exit is the final execution of discipline. Defined risk transforms trading from emotional struggle into controlled execution. It allows the trader to survive losing streaks, remain present for winning ones, and maintain psychological stability across both. This rule endures because it is not about markets. It is about behavior. And behavior, left unmanaged, always destroys capital. Patience is not simply waiting. It is the active discipline of restraint while others surrender to impulse. The market constantly tempts participation, creating movement that looks meaningful but carries no real opportunity. Most traders feel an internal pressure to be involved, as if inactivity were failure. In reality, unnecessary action is the fastest way to erosion. The trader who cannot wait will always be reacting instead of positioning. True opportunity does not appear frequently. It emerges when conditions align, when structure is clear, and when risk can be defined with precision. Everything else is noise. The impatient trader trades noise and mistakes motion for progress. He feels productive, but slowly, leads capital. The patient trader may appear inactive, but he is preserving strength for moments that matter. Impatience often disguises itself as confidence. Traders convince themselves they are anticipating rather than guessing. They enter early, hoping to capture the entire move, unaware that early entry carries the highest uncertainty. The market offers no reward for bravery without confirmation. Those who rush ahead of evidence expose themselves to unnecessary risk. Waiting is uncomfortable because it offers no stimulation. It forces the trader to confront boredom, doubt, and the fear of missing out. These emotions are powerful, and the market exploits them relentlessly. Most losses occur not during chaos, but during quiet moments when traders create trades to escape discomfort. Discipline requires enduring boredom with the same seriousness as managing risk. Patience also extends to letting trades work. Exiting too early out of fear is another form of impatience. Once a trade is entered correctly, with defined risk and proper size, it must be allowed to unfold. Micromanaging every fluctuation destroys expectancy. The market does not move in straight lines. Those who demand immediate reward will abandon good trades prematurely and sabotage their own edge. Impatience creates overtrading. Overtrading creates emotional fatigue. Emotional fatigue leads to mistakes. This cycle is subtle and deadly. The trader may not notice it immediately, but over time, it erodes confidence and clarity. The patient trader avoids this trap by trading less, not more. The market does not reward urgency. It rewards alignment. Alignment cannot be forced. It must be recognized. The trader who it's for clarity operates from strength, not desperation. When conditions finally align, action becomes obvious and decisive. There is no hesitation because the work was done during waiting. Patience protects capital, but more importantly, it protects judgment. Clear judgment is the trader's greatest asset. Without it, no rule can be followed. With it, discipline becomes natural. This principle never becomes obsolete because the pressure to act will always exist. Technology may change, but human impatience remains constant. Those who master waiting gain an advantage that no indicator can provide. They trade less, lose less, and position themselves to gain more when it truly matters. Position size determines whether a trader thinks clearly or emotionally. It is the invisible force that amplifies every psychological weakness. A trade entered with proper size feels manageable, even when it moves against the position. The same trade entered with excessive size feels threatening from the first unfavorable tick. Nothing else changes, yet behavior shifts immediately. This is why accuracy alone means nothing without control of size. Many traders believe being right is enough. They focus on entries, patterns, and predictions, assuming success will follow if direction is correct. The market exposes this illusion quickly. A trader can be right and still lose badly if size is inappropriate. Large size removes flexibility. It forces decisions driven by fear instead of logic. The trader becomes defensive, protective, and reactive, all of which are incompatible with discipline. Proper size allows patience. It allows the trader to sit through normal fluctuations without emotional interfere. NCE. Improper size demands immediate gratification. Any delay feels like danger. This pressure leads to premature exits, stop adjustments, or impulsive reversals. The trade stops being managed and starts being survived. Overconfidence often leads to oversized positions. After a winning streak, traders increase exposure, believing recent success validates greater risk. The market punishes this behavior consistently. Winning does not reduce uncertainty. It only inflates ego. Ego is blind to risk. Size must remain constant regardless of confidence or excitement. The rules do not change because emotions do. Underestimating size is equally dangerous. Traders often measure risk in points or percentages without considering emotional impact. A technically small loss can feel catastrophic if size exceeds psychological tolerance. Once emotional limits are crossed, rational execution disappears. The trader may freeze, hesitate, or abandon rules entirely. Size is also a form of risk control before entry. It determines the maximum damage a mistake can cause. No trade should have the power to significantly alter the trader's mental state or account. When a single outcome carries that weight, discipline becomes impossible. The market does not require aggressive exposure to be profitable. It requires consistency. Consistency is impossible when size fluctuates based on emotion. Professional behavior demands uniform exposure, so results reflect skill rather than impulse. Traders often seek excitement without realizing excitement is the enemy. Calm execution produces repeatable results. Large size introduces stress, urgency, and desperation. These emotions cloud perception and distort judgment. NT. The disciplined trader respects size because he respects survival. He understands that being able to trade tomorrow is more important than winning today. By controlling size, he maintains emotional stability, preserves capital, and allows probability to work. This rule remains timeless because human psychology has not changed. Size still determines behavior, and behavior still determines outcome. Master size and discipline follows. Ignore it, and even the best ideas will fail. The market does not reward anticipation, it rewards confirmation. Entering a trade before conditions are proven is an attempt to be clever, not disciplined. Many traders believe that early entry offers better reward, but they ignore the cost of uncertainty. Before confirmation, the probability of error is highest. The trader is no longer aligned with the market, he is trying to lead it. Confirmation is not about perfection. It is about evidence. It is the market demonstrating that supply and demand are shifting in a way that supports the trade idea. Without that demonstration, every entry is a guess, regardless of how logical it appears. The disciplined trader waits for proof, even if it means sacrificing the first portion of a move. Impatience pushes traders to enter on assumption. They convince themselves that a setup should work. The market has no obligation to fulfill expectations. It responds only to pressure. Confirmation shows that pressure exists. Until then, the trade is incomplete. Waiting for confirmation requires humility. It accepts that the trader does not know the future. It places authority in price, not opinion. This mindset protects against false confidence and reduces emotional attachment to outcomes. The trader becomes an observer first and a participant second. False breakouts, failed patterns, and sudden reversals exist to punish those who act without confirmation. These traps are not random. They are consequences of crowd behavior. When too many traders anticipate the same outcome, the market often moves against them. Confirmation filters these traps by forcing patience. The cost of waiting is small compared to the cost of being wrong. Traders fear missing moves, but missing a trade causes no damage. Entering incorrectly does. The disciplined trader measures success by quality of execution, not frequency of participation. Confirmation also improves risk definition. When a move is validated, invalidation becomes clearer. Risk can be placed where the idea is objectively wrong, not where it merely feels uncomfortable. This clarity stabilizes execution and reduces emotional noise. Traders often argue that confirmation leads to late entries. In reality, late entries are expensive only when size is mismanaged. Proper size neutralizes the disadvantage of waiting. The trader trades probability, not pride. The market offers endless opportunities, but only a fraction are worth taking. Confirmation narrows focus and eliminates low-quality trades. Fewer trades taken with clarity, to perform constant participation driven by fear of missing out. This rule persists because human impatience persists. Technology accelerates access, but it does not improve judgment. The trader who waits for confirmation aligns with reality instead of prediction. He trades what is happening, not what he hopes will happen. That alignment is the foundation of longevity. Discipline is most vulnerable after success. Losses enforce caution, but wins create comfort, and comfort weakens rules. After a series of profitable trades, the trader begins to feel validated. Decisions that were once deliberate become casual. Risk limits feel conservative. Size feels easily expandable. This is the moment when the market quietly prepares its correction. Winning does not change uncertainty. The next trade is not safer because the last one worked. Probability does not remember past success, yet the human mind does. It builds narratives around recent outcomes and mistakes momentum for control. This false sense of control is more dangerous than fear because it hides risk behind confidence. Many traders believe discipline is about surviving losses. In reality, discipline is about surviving success. Losses hurt, but they rarely cause recklessness. Success does. After winning, traders loosen standards. They enter marginal setups, rationalize poor entries, and hold positions longer than planned. Each small deviation feels harmless until accumulated damage becomes visible. The market punishes inconsistency, not optimism. When rules are followed only during adversity and abandoned during comfort, results become unstable. The trader experiences cycles of sharp growth followed by sharp decline. Never run. Understanding that the cause is behavioral, not technical. Consistency requires treating every trade as independent. Past profits must not influence present decisions. Size, risk, and execution must remain constant regardless of emotional state. This neutrality is difficult because success creates emotional attachment to outcomes. The disciplined trader learns to detach quickly, viewing wins as completed events with no authority over future behavior. Celebrating profits excessively is another subtle threat. Emotional highs distort judgment just as much as emotional lows. The professional acknowledges success quietly and returns to process. The goal is not excitement, but repeatability. After wins, the trader must actively slow down. Review rules. Confirm conditions. Reduce exposure if necessary. This deliberate restraint protects against impulsive escalation. It may feel counterintuitive to tighten discipline after success, but history shows that most significant drawdowns begin immediately after periods of confidence. The market does not object to confidence, it objects to arrogance. Confidence is quiet and measured. Arrogance is loud and careless. Discipline keeps the trader grounded, reminding him that the market remains larger, stronger, and indifferent. This rule endures because human nature celebrates success prematurely. The trader who survives learns to fear comfort more than loss. He understands that discipline is not tested when conditions are difficult, but when they are easy. By maintaining structure after winning, the trader protects capital, clarity, and longevity. Success becomes sustainable instead of destructive. The market respects this restraint because IT aligns with reality, not emotion.